The nice thing is if in your 50s, you have a lot of time horizon, right, before you have to start taking money out. But what I'm telling my clients is this is an event risk as opposed to something that emanates from macroeconomic conditions. And so the traditional risk management tools we might use, like asset allocation or modern portfolio theories, really don't hold true because you're seeing the sell-off broaden to all asset classes. And so what I'm telling somebody in their 50s is now we have to be proactive. Now you still have some growth that you need. You obviously can't stick your head in the sand, no need to panic, but certainly we can carve out a piece of the equities that you have in the portfolio.
Ivory, just one tactical example of what that might look like for a client this week, one very specific example.
A specific example would be I would take a portion of their equity position, things that are winning, like the utilities and the REITs that we've owned for the last 18 months, and I would use an innovative ETF. Somebody who's 50 years old, I'd say, well, you still need the growth. We're going to buy something that caps out at, say, 15%. So after 15%, you don't participate anymore. But now you've defined your loss, right? So now the first 9% on the way down, you don't participate. If it goes down 15%, you only lose 6%. So that way, you're not taking money and putting it on the sidelines and not participating if the market were to rebound.
So are these kind of structured notes, or are you using some options in these strategies? And how would this change if you're in your 60s?
Right. Well, if you're in your 60s, you want that cap. Your cap's going to be lower. Remember, risk is always in direct proportion to return. So you're going to have maybe a higher buffer. Maybe your buffer is 15%, but now the cap is only going to be 10%. So it operates very much like a structured note. They're using derivatives so they can capture and put the limits on there. But it's an ETF. So you're only paying 80 basis points. And you have complete liquidity. Okay,
so you pay a little bit more than you would for a market product, but with a kind of a known on your gains and losses. So you think someone in their 70s should have a bigger buffer, so to speak. What does that look like?
Well, the buffer then, they have buffers for 30% that are coming out in March, but the cap is going to be somewhere in the range of 7%. Obviously, somebody in their 70s, particularly if they're taking money out. Now, you're dealing with the sequence of distribution, right? If you're pulling money out when the market's going down, you don't have as much when it goes back up. So the potential to run out of money, before, during the course of your retirement increases. So you want to have a bigger buffer, even if that means a lower cap, because, again, they're not trying to appreciate as much as they are maintain their quality of life in the portfolio.
So you're not worried about derivatives, the famous Warren Buffett line, they're weapons of mass financial destruction?
Right. No, I don't think these aren't credit default swaps, and they're pretty liquid. So I think we're good in that regard.
All right, Ivory, with some innovative strategies here for folks in their 50s, 60s, and 70s. Thank you for joining me.
No, you're welcome.
Ivory Johnson of Delancey Wealth Management.